Silver is trading at $78 right now. The miners are getting $69 from government contracts. Shanghai is paying $99. COMEX has 88 million ounces left, and it's draining at 20 million ounces per month. And in the next 48 hours, two events could collide that either send silver to $100 or create the buying opportunity of the decade. That's not hype. That's the math. And I'm going to walk you through exactly what's happening, why most investors are completely missing it, and whether this moment represents a generational entry point or a trap. Here's what you need to understand right now. The United States military has staged the largest concentration of firepower around Iran since the Iraq invasion. 2 aircraft carrier strike groups, over 100 fighter jets, B-52 nuclear-capable bombers, a specialized aircraft called the Nuke Sniffer designed to detect radioactive material. This is not a bluff. This is preparation for kinetic action. At the exact same time, the Supreme Court is scheduled to rule on whether Trump's tariff regime is legal. They've been deliberating for over 100 days. If they strike down the tariffs, we could see a short-term pullback in metals. If they uphold them, inflation stays elevated and silver keeps climbing. These two events create a very specific dynamic for silver. And I don't think most investors understand it. War is bullish for silver. Tariff relief is temporarily bearish. Both are happening in the same 72-hour window. So the question becomes, do you buy now, do you wait, or do you stay on the sidelines? I've been analyzing precious metals for years. I've never seen a setup quite like this one. The structural case for silver has never been stronger, but the short-term picture has never been more volatile. And that combination creates either massive opportunity or massive risk, depending on how you position. Let me give you the roadmap for this video because I'm going to cover everything you need to make an informed decision. First, I'm going to break down the silver supply crisis that nobody is talking about. The COMEX vault numbers, the miner premiums, the government price floor, the Shanghai arbitrage, all of it. Because you need to understand the foundation before you can evaluate the opportunity. Second, I'm going to walk through the Iran war scenario and explain specifically why silver responds differently than gold to military conflict. This is crucial, and I don't see anyone else covering it. Third, I'm going to explain the tariff ruling, what happens under each outcome, and why any pullback from that ruling might be the last cheap silver you ever see. Fourth, I'm going to give you a specific framework for evaluating whether this is a buying opportunity based on your situation, your timeline, and your risk tolerance. Nobody else is putting all of this together. The silver analysts cover supply deficits, the geopolitical analysts cover Iran, the macro analysts cover tariffs, but nobody is showing you how all three forces interact and what that means for the specific entry point decision you need to make this week. That's what finance currency is here to do. Connect the dots that others miss. Give you the frameworks that others don't share, help you understand what's really happening so you can make decisions with confidence. So let's go. Before I dive into the supply crisis, let me establish something important. Silver at $78 feels expensive to most people. If you've been watching silver for years, you remember when it was $22, you remember when it was $26, you remember thinking $30 was expensive, and now it's $78. And the question in your mind is probably, did I miss it? Is it too late? Am I buying the top? I want to address that directly because it's the most important psychological barrier standing between most investors and what I believe is still an incredible opportunity. The answer depends entirely on which price you think is real. Is it the COMEX price of 78? Is it the Shanghai price of 99? Is it the government contract price of 69? Or is it something else entirely? Because here's the paradox. If the government is paying miners $69 for silver that COMEX says is worth $55, then the government thinks the real price is higher than the market says. If Shanghai is paying $99 while New York says $78, then the world's largest consumer thinks the real price is higher than what Americans pay. And if COMEX registered silver has dropped to 88 million ounces and it's draining at 20 million per month, then in less than 5 months, there's no registered silver left to deliver. What happens to the price then? These aren't hypothetical questions. These are mathematical realities that the market is going to have to resolve. And I think that resolution happens sooner than most people expect, possibly triggered by the events of this week. Welcome to Finance Currency. If you're new here, subscribe and hit the notification bell. I cover silver, gold, and the hidden forces moving these markets every single day. One click from you helps thousands more see this before it's too late. And right now, with war on the horizon and a Supreme Court ruling pending, timing has never mattered more. let me show you what's really happening with silver supply, because this is the foundation of everything. Let me start with the numbers that keep me up at night, because what's happening in the COMEX vaults right now is unprecedented. And I don't think most silver investors understand how close we are to a breaking point. COMEX registered silver, the metal that's actually available for delivery against futures contracts, has dropped to 88 million ounces. That sounds like a lot until you realize it was 199 million ounces just 5 months ago. That's a drop of 111 million ounces in 5 months. Do the math. That's 20 million ounces per month of drainage. At that rate, COMEX runs out of registered silver in less than 5 months. And here's the thing, that rate isn't slowing down. If anything, it's accelerating. The March delivery period is 5 trading days away. If we see the same kind of demand we saw in previous delivery months, that 88 million ounces could drop to 60 million by the end of March. What happens when registered silver hits zero? Nobody knows for certain because it's never happened before. But I can tell you what logically has to happen. Either they halt deliveries, which destroys confidence in the entire futures market, or the price explodes higher until physical silver comes out of hiding, or they change the rules, again, to delay the reckoning. Option 3 is what happened on January 30th when they crashed the paper price 46% in a single day. They raised margin requirements. They shook out weak hands. They bought themselves time, but they didn't solve the underlying problem. The physical shortage is still there. The drainage continues. Now let me tell you about the development that confirmed everything I've been suspecting. First, Majestic Silver reported earnings this week, and buried in their presentation was a number that should have made headlines but didn't. The U.S. government is paying First Majestic $69 per ounce for silver through strategic supply contracts. Let me say that again. COMEX says silver is worth $78, but the U.S. government is paying $69 for silver that the market says is $55. That's a 25% premium over spot. Why would the government pay a premium? Because they know something. They know that when they need physical silver for defense applications, for solar panels, for electronics, they can't just buy it on the open market at spot price. They need guaranteed supply. And guaranteed supply costs more than paper promises. This is what I call the government price floor. The U.S. military needs silver for Tomahawk missiles, for guidance systems, for communications equipment. They can't run out, so they're locking up supply at premium prices before the crisis hits. And they're not the only ones. Industrial buyers are doing the same thing. Samsung needs silver for semiconductors. Tesla needs silver for electric vehicles. Every solar panel manufacturer needs silver. And they're all looking at the same COMEX numbers I just showed you and thinking, we need to secure supply now before it's gone. Here's where it gets even more interesting. While New York is pricing silver at 78, Shanghai is pricing it at 99. That's a $21 arbitrage gap between the world's two largest precious metals markets. In a normal market, that gap wouldn't exist. Traders would buy in New York at 78, ship to Shanghai, and sell at 99, pocketing the difference. The arbitrage would close the gap. But the gap isn't closing, it's widening. Why? Because there's not enough physical silver available in New York to exploit the arbitrage. If you try to take delivery from COMEX and ship it to Shanghai, you're competing against everyone else trying to do the same thing. And COMEX only has 88 million ounces registered. The Shanghai price is telling you what real buyers are willing to pay for real metal they can actually hold. The COMEX price is telling you what paper traders think the price should be. Those two things are diverging, and when paper and physical diverge, physical always wins eventually. Let me give you the bigger picture on silver supply because the COMEX situation is just the surface. The Silver Institute estimates that global silver production is approximately 830 million ounces per year. Global demand is approximately 1.2 billion ounces. That's a deficit of 370 million ounces annually. Where does the difference come from? Recycling supplies some, above-ground inventories supply the rest, but those above-ground inventories are depleting. COMEX is one example. The London Bullion Market Association vaults are another. ETF holdings have been declining. Central bank holdings are opaque, but likely declining. The world is consuming more silver than it produces. That's been true for years. And every year, the above-ground stockpile gets smaller. Eventually, and I think we're close to eventually, the price has to rise high enough to either reduce demand or increase production. But here's the problem. Silver production can't increase quickly. Most silver is mined as a byproduct of copper, zinc, and lead mining. You don't just open a new silver mine. You open a copper mine that happens to produce silver, and new copper mines take 7 to 10 years to develop. So supply is inelastic. It can't respond quickly to higher prices. That means price has to do all the work of balancing the market. And if demand stays strong, or God forbid increases because of war, The price has to go parabolic to clear the market. That's the structural case for silver. Not speculation, math. And it's happening against a backdrop of war fears and tariff chaos that could accelerate everything. Now let me explain why the Iran situation matters specifically for silver. Because silver responds to war differently than gold, and understanding that difference is crucial for evaluating this buying opportunity. Gold is the pure safe haven. When bombs fall, gold rises. It's simple. Fear drives capital into gold. That relationship is straightforward and well understood. Silver is more complicated. Silver is both a safe haven and an industrial metal. About 50% of silver demand comes from industrial applications: electronics, solar panels, medical equipment, defense systems. The other 50% comes from investment and jewelry. So when war happens, silver gets pulled in two directions. Safe haven demand pushes the price up, but industrial disruption can reduce demand and push the price down. The net direction depends on which force dominates. Here's why I think war with Iran is uniquely bullish for silver. The Strait of Hormuz. 20% of global oil supply flows through the Strait of Hormuz. Iran has explicitly threatened to close it if war breaks out. If the strait closes, even temporarily, oil prices explode. When oil prices explode, energy costs spike. When energy costs spike, inflation spikes. And when inflation spikes, both the safe haven and industrial narratives favor silver. Higher oil prices mean higher transportation costs. Higher transportation costs mean every manufacturer wants to stockpile raw materials, including silver, rather than rely on just-in-time delivery. That accelerates industrial buying. Higher inflation means currency debasement. Currency debasement means investors flee to hard assets. Silver benefits along with gold. And here's the part nobody talks about: defense applications. A war with Iran means the U.S. military burns through missiles, electronics, guidance systems, and communications equipment at an accelerated rate. All of that requires silver, the same silver that the government is already paying $69 an ounce to lock up. Let me show you exactly what's deployed around Iran right now, because the scale of this buildup tells you how serious the situation is. 2 aircraft carrier strike groups. The USS Abraham Lincoln is already in the Arabian Sea. The USS Gerald R. Ford is en route to the Eastern Mediterranean. When both carriers are in position, military planners have the capability for sustained operations. Over 100 fighter jets, F-35 stealth fighters for precision strikes, F-22 Raptors for air superiority, F-15E Strike Eagles for bombing runs, F-16 Fighting Falcons for support, A-10 Thunderbolts for close air support, electronic warfare aircraft to blind Iranian radar, B-52 Stratofortress bombers at Al Udeid Air Base in Qatar. These are nuclear-capable aircraft positioned within striking distance of every target in Iran. The forward headquarters of U.S. Central Command is miles from Iranian territory. THAAD and Patriot missile defense batteries throughout the Gulf states, designed to intercept Iranian ballistic missiles. You don't deploy extensive missile defense unless you expect missiles to be fired at you. An Ohio-class submarine at an unknown location carries Tomahawk cruise missiles. The submarine alone could devastate Iranian command and control infrastructure. And the aircraft I mentioned earlier, the WC-135R, the nuke sniffer, designed to detect nuclear material in the atmosphere. You deploy this when you're planning to strike nuclear facilities and need immediate confirmation of radioactive release. When I look at this deployment, I don't see a negotiating tactic. I see preparation for a sustained military campaign. And every piece of equipment I just described uses silver in its electronics, its guidance systems, its communications. The Iran situation is not just about Iran anymore. Russia and China have inserted themselves into this conflict in ways that matter for silver. Russia, China, and Iran just launched joint naval exercises called Maritime Security Belt 2026 in the Strait of Hormuz. Russian warships and Chinese naval vessels are operating in the same waters where U.S. operations would occur. That's not a coincidence. That's a message. China dispatched 16 military cargo planes to Iran in late January. Defense analysts believe they're providing air defense systems, communications equipment, and logistical support. China is helping Iran rebuild capabilities that were degraded in the June strikes. Russia has reportedly agreed to supply Iran with advanced Su-35 fighter jets. Russia's foreign minister explicitly warned that any U.S. strike would have serious consequences. They referenced the nuclear facilities under IAEA control and said the risks of a nuclear incident are real. This is the CRINC alliance in action. China, Russia, Iran, North Korea. 4 countries aligned against Western interests with combined control over significant portions of global commodity production. China buys 90% of Iran's oil exports. If war disrupts that trade, China needs alternative sources. That disrupts global energy markets. Energy market disruption ripples through every supply chain, including silver. Here's the bottom line for silver investors. War with Iran doesn't happen in isolation. It happens in a world where Russia and China are actively supporting Iran. It happens in a world where supply chains are already strained by tariffs. It happens in a world where COMEX has 88 million ounces left and is draining fast. War adds chaos to a system that's already at breaking point, and chaos favors holders of physical metal. Always has, always will. Now let me flip to the other side of this equation, because the tariff ruling creates a specific dynamic that could produce the buying opportunity I mentioned in the title. The Supreme Court is deciding whether Trump's use of IEPA, the International Emergency Economic Powers Act, to impose tariffs is legal. This law was designed for sanctions during national emergencies, freezing assets, blocking transactions with hostile entities. No president had ever used it for tariffs before Trump. Lower courts said he overstepped. The Supreme Court heard arguments in November. Both liberal and conservative justices expressed skepticism. They've been deliberating for over 100 days while the government collected $130 billion in tariff revenue. If the court rules against the tariffs, that revenue might need to be refunded. Treasury Secretary Bessent warned the liability could reach $1 trillion by June. Justice Barrett called it a complete mess during arguments. But here's what matters for silver investors. Tariffs are inflationary. They raise the cost of imported goods. Those higher costs flow through the economy as higher prices for consumers. That inflation has been supporting precious metals prices for months. If tariffs get struck down, inflation expectations drop, the dollar strengthens, risk appetite returns, money flows from safe havens back into risk assets. In that scenario, silver could pull back. How much? Nobody knows for certain. But I could see silver dropping to 70 or even 65 on a tariff strike down ruling. That would feel like a crash to people who bought at 78. Headlines would scream that the silver bull market is over. But would it actually be over? Here's why I think any tariff-related pullback would be a buying opportunity rather than a trend change. The structural factors driving silver don't disappear because of a court ruling. COMEX doesn't magically refill. The 88 million ounces registered is still 88 million ounces. The 20 million ounces per month drainage rate doesn't stop. The delivery crisis 5 trading days away doesn't get postponed. The government price floor doesn't vanish. The military still needs silver. The contracts paying $69 still exist. Industrial demand from defense applications continues regardless of tariff policy. The Shanghai arbitrage doesn't close. If COMEX silver drops to 70 while Shanghai pays 95, the arbitrage widens. More metal flows east. The drainage accelerates. The physical squeeze intensifies. The structural deficit doesn't reverse. Global demand still exceeds global supply by 370 million ounces per year. Above-ground stockpiles continue depleting. New mine supply can increase for 7 to 10 years. And here's the key point. Even if tariffs get struck down, the administration has explicitly said they'll reimpose them through different legal mechanisms. They can go through Congress, they can use other statutory authorities, they have backup plans. So a negative ruling creates a temporary window. Tariffs come down, dollar strengthens, silver dips, then tariffs come back through alternative channels. Inflation resumes. Silver recovers and continues its structural bull market. That temporary window could be the last time you see silver under $75. Maybe ever. Because once the tariff noise clears, the fundamentals reassert themselves. And those fundamentals say much higher prices. So let me give you a framework for thinking about this as a potential buying opportunity. The question isn't whether silver is expensive at 78. The question is what price you'll wish you paid 6 months from now, or 12 months from now, or 5 years from now. If COMEX registered silver hits 0 and they have to halt deliveries, what happens to the price? If the Strait of Hormuz closes and oil hits $200, what happens to inflation and precious metals? If the government is paying $69 today, what will they pay when the shortage intensifies? When I think about those questions, 78 doesn't feel expensive. It feels like early innings. But I also recognize that volatility is coming. The next 72 hours could see wild swings. A tariff ruling could drop silver 10%. A strike on Iran could spike it 10%. Both could happen in the same week. So the buying opportunity isn't necessarily right this second. The buying opportunity is having the framework to recognize what a dip means and the courage to act on it when others are panicking. If silver drops to 70 on a tariff ruling, is that a buy or a sell? Most people will panic. They'll see their position underwater. They'll fear lower prices ahead. They'll sell into weakness. The finance currency framework says the opposite. A tariff-related dip is temporary noise on top of permanent structural change. The noise fades, the structure persists. Buy the noise, hold for the structure. That's the opportunity. Not predicting the exact bottom. Nobody can do that. The opportunity is understanding what causes price movements and responding appropriately when they happen. War headlines mean buy. That's not noise, that's trend. Tariff rulings mean evaluate. Is the structural case intact? If yes, dips are gifts. COMEX drainage data means accumulate steadily. The math points one direction. That's the framework. Simple but not easy, because in the moment when prices are falling, everything screams to sell. Having a framework gives you the clarity to do the opposite when the opportunity presents itself. Now let me tell you exactly what I'm watching over the next 72 hours and what each event means for your buying decision. Number 1, the Supreme Court ruling. The court is scheduled to take the bench today. They could rule at any time. If they strike down tariffs, watch for an immediate silver pullback. That pullback is your potential entry point. Don't chase the falling price. Let it settle. Buy the stabilization, not the crash. If they uphold tariffs, silver continues its current trajectory. No dip opportunity from this catalyst. The buying decision reverts to the war scenario. Number 2, the USS Gerald R. Ford Carrier Strike Group position. When both carriers are in the Eastern Mediterranean and Arabian Sea, military capability is complete. U.S. officials have specifically said the Ford's arrival is a key factor in timing. Watch for arrival confirmation. That's when the war clock accelerates. Number 3, any Trump statement on Iran timeline. Yesterday, he said 10 to 15 days. His advisors are saying shorter. Any statement compressing the timeline further should be treated as a buy signal for silver. War premium needs to be priced in. Number 4, the COMEX daily vault report. If Friday and Monday show accelerated drainage, that confirms physical demand is spiking ahead of March deliveries. More drainage means tighter supply. Tighter supply means higher prices. Each vault report is a data point confirming or denying the structural thesis. Number 5, the Shanghai premium. Watch the spread between Shanghai and COMEX pricing. If it widens after any pullback, that tells you Eastern buyers are aggressively accumulating on the dip. Follow the big money. They know what they're doing. Let me talk directly to you based on your situation because different viewers need different approaches. If you have no silver position and want to start one, this week offers 2 potential entry strategies. First, if the Supreme Court strikes down tariffs and silver dips, that's your entry. Buy physical silver on the pullback. Don't wait for the absolute bottom. Buy the stabilization after the initial panic selling exhausts itself. Second, if no tariff dip materializes and war appears imminent, the entry is now. Waiting for a dip that doesn't come means watching the price run away from you. If you have a partial silver position and want to add dollar cost average through the volatility, don't try to time the exact bottom. Make your next purchase now. Make another purchase after the Supreme Court ruling, regardless of direction. Make another purchase on any significant dip. Spread your buying across the week. That approach captures the average price and removes the anxiety of perfect timing. If you're fully positioned in silver, hold. Do not sell into any short-term dip caused by tariff rulings. The structural case remains intact. Any pullback is temporary noise. Selling now means potentially buying back higher later. The holding cost is patience. The reward for patience is participation in the full structural repricing. If you hold paper silver like SLV or futures contracts, understand the risks. January 30th showed what happens when prices move too fast. They crash paper prices 46% in a single day. They raise margin requirements. They changed rules. Paper positions are vulnerable to exactly this kind of intervention. Physical silver in your possession cannot be margin called, cannot be halted, cannot be rule changed. There's a reason I keep saying physical. I mean it. Let me give you my probability-weighted framework for what happens to silver this week. Scenario 1, war plus tariffs upheld. Probability 35%. Silver outcome, spike to 90 or higher within days. Both safe haven and inflation narratives fire simultaneously. This is the most explosive upside scenario. Scenario 2, war plus tariffs struck down. Probability 30%. Silver outcome, volatile with upward bias. War premium dominates tariff relief. Net direction is up, but with more chop, expect 85 to 90. Scenario 3, deal plus tariffs upheld. Probability 20%. Silver outcome, consolidation. War premium fades, but tariff inflation remains. Silver holds 75 to 80. Structural case intact, but no immediate catalyst. Scenario 4, Deal plus tariffs struck down. Probability 15%. Silver outcome pullback to 65 to 70. Both bullish catalysts removed simultaneously. This is the only scenario with meaningful downside. But even here, the pullback is temporary because structural factors remain. Add those up. 65% of outcomes send silver higher immediately. 20% keep it stable. Only 15% create a meaningful dip, and that dip would be temporary. The risk-reward math favors being positioned, not financial advice, your decision, but that's how the probabilities stack. Here's the line I want you to take away from this video. They can strike down a tariff. They can crash the paper price 46% like they did in January. They can raise margin requirements. They can change exchange rules. They can issue bearish analyst reports. They can run negative headlines. But they cannot put silver back in the ground. They cannot refill COMEX vaults that are draining at 20 million ounces per month. They cannot cancel the government contracts paying $69. They cannot close the Shanghai arbitrage. They cannot reverse a 370 million ounce annual supply deficit, and they cannot undeploy 2 aircraft carriers from the Persian Gulf. The things that are driving silver higher are physical, geological, mathematical, real. The things that can push silver lower temporarily are paper, legal, psychological, noise. Physical beats paper, real beats noise. Math beats narrative. You can wait for a dip that may never come. You can watch from the sidelines as the war premium gets priced in. You can hesitate while COMEX drains another 20 million ounces. Or you can understand that $78 is cheap relative to 99 in Shanghai. Cheap relative to 69 from government contracts. Cheap relative to what happens when 88 million ounces becomes zero. The buying opportunity isn't a specific price. The buying opportunity is understanding the setup before everyone else does. Drop a comment and tell me your buying plan for this week. Are you waiting for a dip? Buying now? Dollar cost averaging? I want to hear your strategy. This community is smart and we learn from each other. Share this video with someone considering silver who doesn't understand what's about to happen. They need this framework before the weekend. One share could help them make a better decision. Subscribe to Finance Currency if you haven't already. I'm covering the COMEX data, the Iran developments, and the tariff ruling in real time, every day. The situation is evolving fast and you need to stay informed. Hit subscribe and the notification bell so you don't miss what happens next. Silver is at $78. COMEX has 88 million ounces. Government is paying 69. Shanghai is paying 99. War is 48 hours away. Supreme Court rules today. Either this is the buying opportunity of the decade or it's not. You now have the framework to decide. This is Finance Currency. Stay sharp, stay stacking. I'll see you tomorrow.